There are many other people rightly puzzling as to why gold suddenly reversed $150 per ounce from last week's tag of 34.50. Each footprint on that Friday indicated it was likely Citi's trading desk breaking rank. I'm going to answer Doug's question by walking through the most recent example of the current gold sell-off, which we've just seen, and who was behind it, and what was the objective. Now, Doug's question mirrored a lot of questions, and while this kind of deliberately created air pocket comes as no surprise to many subscribers, long-time subscribers, there are many other people rightly puzzling as to why gold suddenly reversed $150 per ounce from last week's tag of 34.50. Now, it's a good time to kind of quickly hop in on the charts to best illustrate just how counterintuitive the selling actually was, especially as we have very strong physical demand drivers powered by a race by central banks and sovereigns to sell dollars for gold into a series of higher stair steps. I'm going to show some links for that in a little while. But here, let's have a look at the charts. So this leads us to identify who really led the sudden gold sell-off, why they were behind it. And despite their best efforts, all it's done is to discover the next of a series of fresh, physically supported higher stair steps along the way, leading to $4,000 gold and $4,500 gold, but $4,000 being the immediate target. Now, I'm recording this at the pit open on Wednesday, and the Wednesday the 25th, which is also options expiry, and really a good time to sort of check through the footprints leading into it. Just to say though, this is a futures chart, which is trading in sync with spot, except that the futures chart, because it's a further out contract, is actually trading at around about a $13 to $14 premium to spot at this point. And that simply reflects the carry costs into this longer dated contract. So let's start off by looking at the spot 34.50 level, which is currently 34.64 futures. So and that was here, it was higher. So this was pretty much the top of the range. So following very strong SGE, Chinese safe haven physical gold demand at spot 34.50, which had picked up into Friday the 13th, which is pretty much here, just before we opened up on the Monday after. So this was very strong demand and noted on Friday the 13th. And that was obviously to do with heightened war risks and one thing and another. And that followed through with more buying at the SGE Open, Chinese Open on Monday the 15th, for spiking another $20 higher. And then we got a sudden, really essentially the start of a $150 waterfall into the 3,300 level. Now, again, there's about a $12, as you move down, about a $12 premium to futures. So this line represented 3,300 spot. So this picked up steam rapidly, and really at a time when gold really should be doing what it was saying on the box, namely acting as the safe haven. And the selling was extremely counterintuitive. And really this was what drew the attention of the first-tier liquidity providers, whose really job it is to ensure Basel III NSFR compliance at the global-facing FX gold fixes, and were having to supply gold into those fixes into this series of lower prices. And for reference, this is obviously before the PM fix, so I've just marked in where the AM fix was this morning. So the reason I'm showing this is really because we want to step through the footprints as it provides a timely example of how, as Doug puts it, He said, given most people do not own gold, how can it be possible that everyone is selling their gold? And that, we need to answer that question. And this also leads into his questioning about government suppressing the price of gold. So this is a really good question. We're going to drill down into his whole question. Now, the first thing we need to do is differentiate the difference between the tiny percentage of Western-facing funds and people who own or stack real physical gold. There's a big difference. And the physical buyers never sell their gold versus the paper gold traders who place really just high leverage futures bets targeting a higher or a lower cash settled gold price expectation. Now, we call them obviously the speculators. Now, these paper or synthetic gold traders what they're doing is borrowing gold from what is essentially a cartel rigged casino environment with the house pitched against them. Now, we call it the COMEX casino, where you can borrow exposure to paper gold with only really 4% of skin in the game, which makes it very attractive for speculators. Now, that means a speculator can currently control 100 ounces, a contract of gold worth $340,000 for a tiny $15,000. Now, the trouble is, leverage works both ways. And in this case, these speculators have been buying gold for the similar reasons as physical buyers do, except for one very big difference. Paper gold can be created out of thin air, while physical gold is limited in supply and is extremely sensitive to supply-demand fundamentals because physical gold is globally fungible. This is the important part. It's globally fungible. No matter where you go in the world, gold is recognized as money, and it's the same value around the world, whatever that value of that gold is each day. So that each physical ounce, kilo, ton, that is purchased in the physical markets tightens a single source of available supply and incentivizes the next seller to raise the price to get the best price, as you would do in a normal market environment. Now, quite the opposite if a speculator buys or sells freshly generated paper gold futures contracts, which are not physically settled, and the resulting supply and demand price that comes out of that is purely synthetic. Now, while this COMEX tail wagging the 10 times larger physical dog does influence the 2 daily global gold fixes, it's only to the degree where the COMEX pit managers can actually lay off the liability into a shrinking number of siloed COMEX speculators. And as we can see, the scope of being able to do so is fast shrinking as the real global facing physical dog begins to actually wag the speculators right off the COMEX tail. Now, while physical buyers are competing to exchange fiat for gold or actually maybe just to help hedge their wealth against rapidly debasing debt-backed dollars or pounds or yens, whatever it is, and this is done into a limited global supply. Now, given the exponential pace of fiat money debasement, you just have to look. Go down to the grocery market. You just have to look any chart and you will see just how many more dollars it takes to buy anything. So what the physical guys do is look at these fiat money debasements and value gold as a consequence, value gold literally hundreds to thousands of dollars higher than is currently being offered for sale, because it's being offered for sale in a diluted form. And it's not that gold is actually going up. It's simply that the same ounce of gold, the ounce of gold benchmarks really the loss of purchasing power of no matter what currency you're in, the full range of rapidly debasing fiat currencies. Now, each day, each month, quarter, year, decade that goes by, it simply requires more freshly printed dollars to buy the same ounce of gold. That's really what's happening to gold. Now, in contrast, highly leveraged casino gold speculators, and they're literally corralled inside the COMEX casino, and they have US traders have no ability to trade the spot delivery physical markets. So, in consequence, they have no visibility into the real wholesale market supply-demand fundamentals, whereas the house does. So, with this knowledge, the house knows exactly how many chips to lend to create enough liquidity to set a non-deliverable casino ticker price for gold. You know, when you're in a casino, you see a ticker price going on. It could be racing, it could be anything. I mean, that's their number, that's their presentation. And this is how the cartel generates regular wash and rinse cycles. And that's something we're seeing now, which is why this question is pertinent. Now, given the casino pit managers hold the book on the chips borrowed from them on margin, and the house runs this ticker the specs actually knee-jerk react to, in aggregate, the house market makers know exactly where the speculators will be forced to sell their positions. And just like any other casino setup, the house wins 95% of the time. And as the LBMA CME market makers act as a cartel, it's really sanctioned wire fraud by any other name. Now, while there are legitimate reasons for trading futures contracts, that could be to trade physical positions, producer or refiner hedging, these bets are not speculative and tend to be sticky in nature, and they're not to any degree asymmetrically imbalanced. That it is a legitimate hedge, meaning that these positions, which is part of the open interest, which is why you have to look at the breakdown of it, they're not leveraged and they can't be rinsed out, but they can be called on for one-to-one physical delivery at any time, which is something we see sometimes at the back door of the COMEX. However, what we're focusing on, we're actually going to focus, we're really focusing on the leveraged speculators who are simply seeking to profit from price movements for cash settlement. Usually they're on the long side. So it's this simple. Once speculators have borrowed enough chips and the price jumped on for the right evidences the house is on the losing side of that trade, they move in. But this is the key, in unison, because they're market makers and they have a footprint in the FX spot markets, which COMEX traders can have no visibility into or are unable to trade, and they have a footprint in the COMEX. So, but in unison, they can ring the register on these borrowed positions, or as Doug rightly puts it, the exact point where speculators can be margin called by the pit managers to replay these borrowings. So that's the how. And now, using the current sell-off footprints, who and why was gold called down by? Now, given all the gold supply that hit the market emanated out of the 96% leveraged COMEX futures markets, but into this very strong but unleveraged physical, this selling was into unleveraged physical buying, our liquidity providers dug down into the footprints to determine who was behind this latest round of extremely counterintuitive driven gold selling that commenced on Friday the 13th in gold. We looked at that on the chart. Now, each footprint on that Friday indicated it was likely Citi's trading desk breaking rank from all the other bullion banks actively bullish gold calls. In other words, gold prices.